value investing, spotting enduring businesses before, during, and after listing. True value investing is not about low valuations. It is about identifying enduring businesses early, sometimes even before they list, understanding their scalability during growth, and staying invested through cycles with conviction. In today's market, where narratives change quickly and listings happen at pace, the real edge lies in separating durable compounding stories from temporary hype. Now, this session explores how seasoned investors identify long-term value across the entire life cycle of a business, from private markets to public markets and beyond. We are joined by an accomplished panel of investors who approach value from different yet complementary lenses. We're so honored to have with us our panelists, and let me introduce them briefly to you. Mr. Bahal, founder and fund manager at Negen Capital. He established the firm in 2007 and brings over 2 decades of capital market experience. What began as a securities advisory platform has evolved into a portfolio management business recognized with a 5-star CRISIL rating in the multi-cap category. Negen Capital follows a focused strategy centered on special situations and technology-led opportunities with a disciplined, research-driven approach. We also have with us Mr. Vineet Arora, managing partner at NAV Capital. He's a seasoned private banker with over 2 decades of global wealth management experience, and having led global wealth divisions and worked with institutions such as Deutsche Bank, Citi, and IIFL Wealth, he brings deep expertise in portfolio construction and cross-border capital allocation. At NAV Capital, he has been instrumental in scaling assets significantly while maintaining a structured investment discipline. We also have with us on the panel Mr. Nishad Khanolkar, fund manager, Bharat Value Fund, and he brings over 24 years of experience across asset management, private equity, M&A, and fund management. A chartered accountant and CPA Australia member, he has led the conceptualization and launch of multiple SEBI-registered Category 2 funds, including the Bharat Value Fund series. His experience spans global private equity roles and directorships as well across international investee companies, giving him a broad capital markets perspective. We have with us Mr. Abhishek Jaiswal, fund manager at Finavenue Growth Fund. He represents a systematic and quant-integrated approach to value discovery, and with experience in small and mid-cap investing, he combines proprietary quantitative models with deep fundamental research to identify scalable opportunities, particularly within the SME segment. His framework blends data precision with business insight to navigate emerging companies effectively. And moderating this discussion is Mr. Kamal Manocha, founder and CEO of PMS AIF World, who will steer the conversation towards practical insights for investors seeking durable wealth creation. So, gentlemen, a very warm welcome to you. And Mr. Manocha, over to you for this important conversation on value and conviction.
Thank you so much, Aishwarya, and welcome everyone to the second day of Crystal Gazing Summit 7.0. I will just, take you back to 2020 when we had started this series of Crystal Gazing Summit. The approach that we had adopted then, was based on a belief that knowledge first and wealth follows. And I remember, in 2020, it was a COVID time. There was we saw around 500 people logged in at, that summit. Today, we have seen more than 1,400 logins yesterday, in the event. I do not know what is the number right now, but I'm sure, today being Saturday, number would be even higher. So I'm giving you this context, gentlemen, that this is a real forum that we have created to answer some of the realistic questions of our clients as well as investors in general. You have your differentiated strategies, and all our clients who have come to PMS AIF World as a platform, which we position as alpha focused platform for alpha. And obviously alpha is not something which is accidental. It has a process, discipline, a strategy behind it. And it also requires a long-term attitude from investors. So our investors are savvy, they understand all that. But at the same time, in the journey of alpha creation, there is a kind of a doubt that comes, during uncertain times. Like today, again, doubt is kind of erupting whether India growth story is intact, whether AI disruption is a FOMO or it is really going to kind of impact adversely the PE margins of many sectors and industries, and US trade tariffs, are they really impacting India's GDP growth? We have been saying that India's domestic driven economy, our kind of, GDP to export to GDP ratio is like very low in comparison to other larger economies. But is it really impacting? All these are some of the real questions that we have been, and also, small caps. The world of small caps and micro caps is something which we cannot forget, when we are talking about value investing, So all these are realistic aspects that we'll be covering, in this conversation, including the pre-IPO segment where a lot of money has been raised over last 2 years. And my first question to you, Neil, you had started your journey in 2017, which was a peak of, the last bull run, and after which we saw 2018, 19, 20, kind of a 3-year correction. So nobody better than you who has seen that kind of a first starting of a career, such a painful start. And I'm sure, with that painful start, you cannot forget that ever in your life. How do you see, with that as a, I would say, memory, the current fall? Is the small cap or a micro cap fall done? It is overdone? Are you ready to deploy your 80-90% in equities? Do you see this time, with absolutely lens of opportunity, or you are kind of worried?
Good morning. So, yeah, it was a trial by fire when we started. We started at the peak of the last bull market, and then, the first couple of years, the market only kept going down. And I see a lot of similarities from the 2018-19 market to what is going on right now. It was a very polarized market where it was very narrow, and maybe 20% of the stocks were leading the Nifty and the indices in 2018 and 19, while most of the market was down quite a bit. So similar things happening right now. If somebody just came back from a vacation, and saw that the Nifty for this financial year is all right, mid cap index is all right, small cap index is also okay, not down too much. While at the same time, if you're not seeing inside the market, he doesn't know that the broader market is down quite a bit. The fall in the broader market could be as much as 24-25%. So, yeah, I mean, it is what it is. And the only difference from 2018-19 to right now is that we've come into, while everything is same, that we become oversold. The stock market's kind of oversold. We're not too cheap on today's valuations on trailing earnings. We seem to be attractive on 2 years down the line valuations, so on forward multiples. But the only difference from last time to this time is that in last time you could have said that, okay, go and buy everything, whatever you think, just buy it. The world was not so complex as it is right now. Today, you can't say that go and buy everything. You need to be, sorry, you need to be in sectors which are not going to be impacted by a lot of factors, including artificial intelligence. I've been speaking about this for a while. So, this time, you have to be a little bit more focused. The way we defined a business with structural moats, we wanted asset light companies. We naturally looked at SaaS software kind of businesses. And today, that entire business model is threatened. Any teenager sitting in a garage can come up with a code, and some kind of AI agent can come and disrupt you completely in a asset light software business. Today we are kind of moving towards a physically secure business, a physical fortress. I think going forward, the difference between 2018-19 to where we are right now is the preferences of investors will change, because investors eventually over the next year or two will get fed up of disruptions from AI. And then they will say, what is not disrupted by AI? Give me that. Even if it is 15% growth, and even if the ROIC, ROC is a little lesser, I don't care. I want a business that is not going to get impacted, and my value or my store of value remains. So this is the key difference. We are more or less same in terms of market positioning what we were in 2018-19. But I think the change is that you cannot just go and buy everything. If you buy everything, you're toast. You see the IT index is down 22%. Luckily, we have zero IT. But going forward, you have to be in anti-fragile sectors. That's my view.
Sure, Neil, absolutely. No, I think I would fully agree with whatever you mentioned. Moving on to you, Nishad, you have raised almost 8,000 crores in last 3 years. And I think, one person on street who is actually not unhappy and maybe not in pain is you, because 70 to 80% of your money raised is in pre-IPO market. And pre-IPO market has kind of seen very good times, especially in 2023-24, when a lot of money was being kind of pushed to pre-IPO segment. But you have been raising fund after fund, and now you're preparing for big Bharat Value Fund Series 6. And there is this question which is in the minds of investors, including I myself, because I'm also invested in your first two funds, is that while your client impact letters are kind of very, I would say, comforting when we see 1.5x to 2.5x kind of MOIC that is shown, but the kind of reality which is going on in the market, in the world of listed space, kind of you have to face that eventually, because you have to exit those companies once they get listed. And on ground today, we know there is a kind of a brutal correction. Like, market is kind of not sparing companies. Market is very cruel. Wherever kind of market feels there is competition, the P's are kind of contracting. Wherever there is a AI threat, P's are contracting. In your portfolio also, I'm sure ultimately that is going to unfold. How will you exit these companies, for such a large scale of kind of assets that you have gathered? What doesn't that kind of give you a sleepless night, or kind of you feel this all kind of unfolding ultimately positively? I want you to kind of give a very realistic answer, because we really want to address this worry of investors who have given their hard-earned money to Bharat Value Fund.
Kamal, thanks a lot for first of all inviting me on this session. So I understand from where you're coming, there has been a little bit of a turmoil in the listed market. But I always tell my investors whenever I come on the forum, and I do that very frequently, because investors' education and awareness and transparency is the only thing Bharat Value Fund has maintained. That is why we're able to gather so much capital. But see, you should, cycles will come and go. Cycles will come and go. If somebody is trying to say that I can catch the cycle, slightly tough. What you can do is only two things: enter low and complete your compliances. Enter low and complete your compliances. Whenever I come on the call, I show all of my investing companies. Invariably, I talk about the entry level valuations I have entered. Sometimes it is P multiple, sometimes it is growth story, sometimes it is revenue multiple, and vis-a-vis I correct with the listed multiples. Ultimately, somewhere I'm going to get tagged to my listed competitors. As long as you are creating the gap, and even the worst market, say now the market has been corrected. Sorry, pardon me, I'm not using the word worst market. I'm talking about the corrected market. Even in the corrected market, my entry level multiples are much better or much below their listed competitors. So I guess that is giving me a very peaceful sleep. The moment listed market starts going below my entry level P multiple, which is not likely to happen even in this condition, that time I will go for a sleepless nights. So right now, as I say that we have created sufficient gap. So in this kind of industry, Kamalji, I guess let's talk about the last 4 years. You asked Neil about the question about the corona and all those things. Corona was the worst event that probably a mankind has seen in the capital market. I guess 10 months and 13 days we're back to normal. Last 4 years, what has not gone? There was a war in Russia, Gaza, India, Pakistan pseudo war. Markets were up, down, up, down. But we have not seen more than 4 or 5 months that market was down consistently. It will go down, it will come up. So cycles will come and go. Have a faith in the Indian economy. It has to bounce back. It has to bounce back. There is no second thought about that. But you should do only two things. That is, try to create the entry level delta, which in very created. You also agree to that, and complete your compliances. At max 3 months, 4 months here and there, that can happen. That is a given factor in this kind of industry. That's my honest submission to you, Kamalji.
Sure, Nishad. Absolutely, this is good reinforcement. And kind of, we are discussing on value investing, which is like, pre-IPO, at the time of IPO, or after investing. And then, moving on to you, Vineet, your fund, which is now Bharat. where when you launched the fund, the idea was to have 51% allocations to unlisted through pre-IPO and 49% to listed. And you have seen, Neil maintains that market is kind of absolutely kind of close to its bottom in terms of valuations, at least in terms of his reading of market in the current context. And Nishad feels that entry level kind of gap and delta created in the pre-IPO space with good compliances is something which is the source of alpha for him. Now, from your point of view, you are like having a balanced approach. You can enter into pre-IPO or into listed. But at this point of time, where are you more biased? And because today listed space is also meaningfully corrected, where one can actually do better fishing with more information, and the segment is very large in terms of choice. Why would you want to still kind of give 51% allocation to kind of unlisted space, where obviously the decisions will be relatively less transparent and the set is also going to be relatively smaller? If it was 2024, I could understand, because listed space was expensive. Today, listed space is meaningfully corrected. So from that point of view, I'm asking this question because, your team tells us that your intent is to create 70% allocation towards unlisted space, where you wanted to ideally keep 51. Today you are maintaining that 51 actually goes to 70-80%. In today's time, when listed space is meaningfully corrected, why is that so?
So Kamal, thank you for having me here. I think I agree with Nishad to some extent. We are about 65% in our listed space currently. And when the valuations have corrected, they've corrected both in listed and unlisted. So, the same founder who was looking for, let's say, 100 crore valuation will come to you today or agree at 60, 70, because money has become difficult to get. So valuations have corrected on both the spaces. And since we do small caps, micro caps, companies which can potentially grow faster and become eventually small and mid cap kind of companies, if you want to pick up a larger quantity or stake, you cannot buy in listed space because the moment you want to buy, unless you hunt for a block, the price action will happen. So our pivot has been more towards unlisted space. We are doing listed space, but still very, very cautiously, purely because if you want to take a larger position, you can't. And, the markets remain choppy. And I believe, we've seen kind of 2 years of pain in the market. And as Neil was pointing out, the pain actually lies in the stocks which are built outside the index. Index is probably small cap index, even if you take, is down 7 or 10%. But the broader market, which is the below 3,000, 4,000 stocks at the bottom, are probably down 25, 30, 40%. And, in segments like solar, much more. And, these cycles can last for longer than we can endure. Whether the market will bounce back in 2 months, 3 months, we don't know. I mean, last 1 year we've spent, the tariff agreement is not happening and the market is not picking up. That out of the way, we've had EU agreement happening, UK FTA, Australia, etc., but it hasn't had impact on the market. FIs have been pulling out money continuously, and India has underperformed the global markets. Last 1 year, probably we're at the bottom of the pack amongst the large markets. Whether it'll take 3 months, 6 months, 1 year is anybody's guess. But yes, valuations have become fairly attractive now. Economy continues to do well. Inflation is benign, interest rates are low, PMI is high. So all the parameters market is doing well. It's just a question of time when it'll bounce back. So we just need to be patient.
Sure. So you maintain that you will have a bias more towards pre-IPO and unlisted.
Yes, at this point, yes.
Sure. Moving on to you, Abhishek, you have been one of the best performing fund managers in category 3, and maybe today you will win an award also. I do not know. But that's true that in last 2.5 years, your performance has been highest. But in last 1 year, like every other fund manager, you've also kind of seen negative returns. So, anybody who is going to give you kind of fresh capital today, having seen the award that you're getting, with the high expectations, how do you kind of attribute your performance to which came in 2023-24? Was it because of that IPO boom going on, and you were able to kind of do good, I would say, bottom fishing of some of the pre-IPO companies or anchor, investing? Or in your current portfolio, which is comprised of fairly 100 plus companies, you see, a lot of, I would say, potential from here onwards also because today your portfolio is broadly, I think 70-80% listed only, and it is also exposed to market pain, and that is when last 1 year not performed. So think from the point of view of someone who's giving you fresh capital at this point of time, what is the kind of expectation you want to set for that investor over next 3 years?
All right. Thank you. Thank you so much, Kamal, for having me here. To start with the earlier returns and the cycle, the equity market, specifically in the SME and the nano cap space in the early 2023 to 24, performed really well. And of course, all of the fund managers on the street who were invested with the nano cap universe were having the best time of their life. In the last 1 year, when the correction has been much deeper in the space, I mean, leave alone the headline indices, which have corrected by what, 5 to 10% maybe, the bleeding in the sub 3,000 crore and even sub 1,000 crore market cap has been north of 40%. If you look at my average holding market cap on the portfolio level is around that 1,500 crore mark only. And despite the 10% correction odd in the market, Finavenue's portfolio, let's say from December previous year top to right now, would be down what, 5%, 5.5% to be fair. And from the calendar March to right now, we are up 10.5%. Point of view over here is, if you are going to chase any micro cap funds at the best time of their life, maybe you will have a drawdown in your portfolio as well, because let's alone we are exposed there. But you remember the last year March correction, everything was bleeding again on the streets. I went on a virtual note with all of my investors and I asked them that, okay, this is the time where you should come in naturally to, at the fund level to allocate more capital on the nano cap side. And yes, even in the worst performing years in the equity markets, they're up till now. I mean, as a job, the fund manager I have, my job is to manage risk and liquidity at the same time. So you see, Finavenue's portfolio is not just heavily tilted towards the unlisted space. It's 20% balanced. 70%, as you say, is in the listed space, and 10% odd we maintain cash level, to handle any redemption pressures, of course, because these are times of stress. We have been able to deliver again a financial year performance, which is way higher than the market expectation or the market which has delivered. For the future numbers, Kamal, if you have asked me, the average holding at the valuation level of the Finavenue portfolio company is around 17x and below multiple, whereby the earnings of the companies are growing by more than 25%. We cannot do anything more, right? We can assure that we are holding the right set of companies at the right set of valuation. And just like every other panel member has talked about over here, that you cannot time the market, but you can spend more time in the market and really let the situation play out on its own. So I think I'm very optimistic, and market thrives on optimism. It's a matter of time when my optimism reaches to the broader public and the market sentiment gets better for all of us.
Sure, Abhishek, absolutely. Like, this question is for you, Neil. I will just, kind of combine all the perspectives. Nishad mentions that his source of alpha comes from delta, that he's kind of capturing at the entry point. And Vineet also agrees to that, and is also more biased towards pre-IPO in terms of capturing the delta, entering early at a relatively lower valuation. Your portfolio also started like that, and you also gave stellar return in 23-24. You're also top performing fund, but now your portfolio is like almost 80-85% listed with full capital deployed. Like cash levels have reduced over time. So where do you see right now, if you were to give guidance on your portfolio right now in terms of setting expectations for next 3 years for investors who see your portfolio today as a mature portfolio, not a portfolio which is in the building stage? What is the guidance in terms of earnings growth, or sectors or companies you are very, very bullish upon? I know your skin in the game in your own portfolio is very high, so it's like a very realistic answer I want from you on your portfolio guidance.
I would like to go and give any guidance on anything. As you rightly said, my money is in the fund. So obviously, I have a lot of skin in the game that way. But I again like to say one thing: this is not a normal time. This is not a normal time where we expect the markets will go up and everything will go up whenever the market decide to go up. I think the narrowness of the market could remain, and in terms of valuations, we are not at a valuation where you can table thump and say research is not necessary, just buy everything. We are reasonably valued right now, is what I would think, even after the correction. And lots of companies on a 2-year or a 3-year forward basis are very attractively valued. So it's a very much in the zone of a stock pickers market. But as I again say, it's not a place where you can just buy a huge basket of stocks and say that you will do well. It's time to be very focused in your approach. Own companies where the earnings are likely to be protected. The earnings have to have some defensibility from a lot that is changing globally right now. I think I mentioned this already, but the textbook definition of a good business used to be asset light. But I think the textbook definition is going to change towards protection of earnings. So we need to identify sectors where, the next 3 years or next 5 years, our earnings are completely protected. I'll give you an example. Defense is an area where, I don't have to explain. Everyone knows naturally there's currently an arms race going on. So can we have a couple of good defense companies in the portfolio which are not doing commodity businesses, but who have a business where it's hardware plus software? So that if you're just doing software or if you're just doing hardware, it's incomplete for tomorrow's time. Or else, if we are going away from defense, something like a healthcare space, but even in healthcare, something like a hospital space. Like it's not that AI or artificial intelligence can download a hospital bed. The bed is going to be needed, while obviously the surgeries could be done in a robotic manner, but the bed for recovery and so on is 100% going to be needed. So I think going forward in the next 2 or 3 years, there's going to be a massive realization that nothing is safe in that sense. And that's the reason the first thing I did was got completely into listed. I don't want to own anything unlisted right now. Obviously, what we have is a small portion right now, maybe about 12% or 11% unlisted. I want to have the ability to sell if I see that the moats are disappearing, or if the capital allocation is not what I expect in today's changing times. So I want to have an option to sell if I want to sell and reallocate my capital. Yeah, that's my 2 cents. I can't give guidance. It's not a time to give guidance. I have never seen such a delicate time in my life.
Sure, Neil. Sure, absolutely. I really respect the honesty and sincerity with which you answered this question. And I fully agree here as well. Moving on to you, Nishad, you mentioned, in the last point that entry level delta is the source of alpha and source of comfort. That is very important, and where you have done your full compliances and which gives you good, I would say, kind of a position right now in the market context. Absolutely bang on. However, we have always kind of discussed amongst ourselves when we kind of hear from you saying that you try and identify company early at an inflection point, whereby you're entering early, the P is low, and companies at inflection point in terms of, it kind of growing from there. And eventually, as company gets listed and that growth comes out, ultimately, you get P expansion as well as earnings growth, and that is how the returns are generated. Absolutely bang on. But now, the question which was always there in our mind is that why will any promoter, which is that inflection point, will give you low P, for you to have that delta. And I just want you to give, and this is the continuation of the question on the guidance itself. Now it is the time to kind of understand this really, because your portfolios are ready. You have already invested. You know what promoters told you at that point of time. There could be some reality in your portfolio whereby you saw that as an inflection point, but somebody who was diluting equity was at its peak. Maybe 15p was a peak for him. You thought it is an inflection point. If there are any such disappointments, or if there is no such disappointment, which is exactly which will kind of give us even better flavor. That is the reality. I want to kind of you to kind of come out with the full disclosure and disclaimer in terms of your portfolio companies, because you have been now dealing with all these promoters in terms of their reality evolving over last 2 years in terms of the growth potential. The entry level comfort was always there, but now growth potential in the current environment, what is the reality check in that context? Were they really at inflection point when you entered?
So Kamalji, I understand from where you're coming. Every day investors ask me a similar kind of a question कि निशा 10 का P अच्छा है कि 28 का P अच्छा है. So it's like this, neither the 10 P is good and nor that 28 P is bad. So it's basically what you need to do is P is basically क्या है? P reflects the future expectations. So I always tell investors कि when you look at the P multiple, you should look at certain factors. For example, the number one factor that comes is a growth. If a growing trend is there, you will never get a company at a 8P, highly impossible. Second point, you need to, you have to filter 1, filter 2, filter 3, filter 4. So first thing you have to do, you need to check while having a P is a growth. Second is ROC. Ki stable, predictable earnings hai, of course you will have a better P. Most important, very rarely people talk about it in the terms of the trade. Simple hai, if I'm investing 100 rupees in a company, I'm getting 105. Second business, I'm investing 100, I'm getting 120. People think 120 is a better business. But what if you're getting that 105 in 30 days and you're getting that 120 in 1 year? Terms of trade, पहले का अच्छा है. So terms of trade भी आपको देखना पड़ता है. Fourth point is debt equity position. Higher the debt, people think it is risky, so आपका P कम हो जाएगा. Next is the industry structure. Monopoly, duopoly businesses, high P is slightly justified. Commodity businesses, sorry to say, low P is there. Cyclical businesses, very risky. So again, low P. Last point is the quality of the management. Ultimately, we always say that, never invest on a horse. Horse is like a stock. Always invest on a jockey. Jockey is like a promoter. Intent of the promoter, Kamal ji, ठीक है ना? So all these thing factors, भले आपको 10 में से 7 रहेगा, but the intent is 10 out of 10 ना, you can try it out there. Coming back, so these are the parameters, as I said, 1, 2, 3, 4, 5, 6. We look while deciding the P. So 10 ka P or 25 ka P is basically based on the last 5 parameters, as I said. Coming back to your question about when we invested and what is the situation now. You also know that whatever Bharat Value Fund has invested till today, more than 85% money invested by us is a growth capital, is a primary. Very rarely we have indulged in a secondary. So secondary may or may not help you in increasing the balance sheet size. But since we have infused 85% growth capital, plus most of the time promoter themselves are not diluted. They are holding super majority stake in all our companies. So जो बोलते हैं ना कमल जी, mind mapping is more important than the watertight agreement. Promoter is not selling his stake. He has taken a growth capital. His second generation is into businesses. Cyclical event, what we are talking about, is a part and parcel of the game. But in long run, they will not teach you. So growth capital and promoter intent, and this is something which we have as such never deviated from our principles. And that's where, coming back to your first question, that is also a second reason why I'm getting a peaceful sleeps nowadays.
Sure, Nishad, absolutely brilliant. I really kind of see this as a convincing answer. Moving on to you, Vineet, you have been a wealth manager before, actually now diving into the world of money management. And I'm sure, you understand the pain of wealth management industry. There are hardly any products which give consistent long-term alpha. Soon investors, fund managers, they start chasing assets, and ultimately alpha kind of takes a back seat. And I'm sure you're trying to kind of be a boutique fund house focusing on alpha. I want to understand from you, as a fund manager now in that journey, how do you spot companies? Because in wealth management, I know, it's like we acquire clients based on trust, based on relationships, based on reputation that we build. And as a fund manager, how will you source some of these pre-IPO companies? What is the kind of, connect, what is the network? What is the, I would say, strength you carry? Because that is something which will determine your alpha eventually, right? And I'm trying to understand the source of alpha, in your portfolio, in your approach, in your strategy.
So we spend a lot of time on the ground. The key is actually going to tier 2, tier 3 cities where a lot of these manufacturing businesses or a lot of good promoters are there who actually do not have access to the PE VC money, they can't speak properly good English or make a good presentation, but are very good at their businesses and what they do. So we spend a lot of time on the ground, travel to tier B, tier 3 cities, meet the companies, see their businesses, spend time with them, understand them, and then guide them and mentor them through the journey, right from investing to taking them to the markets. So I think that's what differentiates us. And of course, for example, for me, my entire wealth is invested in India. And, both the funds that we run out of Singapore and India, 20% of the capital is actually your own personal capital. Uh, so, we are invested, we are committed, skin in the game, aligned with the investors, and spend a lot of time on the ground. Because deal flow comes, I think we've done over 100 plus SME IPOs and, about 20, 15, 20 main board IPOs as anchor investors. So a lot of deal flow comes from the entrepreneurs, their friends who help them. One good entrepreneur will refer you another. Uh, then, of course, a lot of intermediaries, merchant bankers, investment bankers. Uh, the key difference is we look at every deal. We go through every deal, we spend some time. There's a filtration process. Some goes out, and anything which fits into a criteria is then we start doing a deeper look at it, more DD, do plant visits, site visits. So that's a process we've followed for last 3.5 years, 4 years that we've been running the fund, and we continue to follow that. And in the process, we've actually had many multi-baggers as well. Companies who were like the first company we invested, which we continue to hold, we invested at enterprise value of 85 crores. Today, the market cap is 3,500 crores. We've taken a capital out, but there's a significant upside and we still hold because the trajectory is still clear. The company is growing at a 40-50% CAGR, and the PE is not high, trades at a 15-17 PE. With that kind of CAGR, where the visibility is there, and you're able to identify a lot of such companies. The key is patience there. These are the companies you're actually giving them, as Nishad saying, growth capital, but they're not. Uh, a lot of them are a bit asset heavy. So we've never done asset light businesses, much of them. We prefer, a lot of manufacturing. So once you give them capital, the guy needs time to set up his new plant, do his capacity expansion before you start seeing the results. So it's not that, even a small company who's done an IPO now should double or triple. Those days, probably gone a year and a half back. But, he's received capital today. They'll spend the capital, they'll invest into, manufacturing or whatever they're doing, and then you'll see the results. So you need to have that patient capital before you start seeing that kind of returns, which were there some time back. Of course, pre-IPO gives you that uh, time also to actually nurture the business, and you have longer vision. You can take a 3-4 year call rather than a 6 month call. But then there are times when something runs up too fast, too quickly. You'll take your money off the table when you feel that 2 साल के बाद का भाव आज ही आ गया, for example.
No, I kind of see a lot of, I would say, real work that you are doing, not just textbook work, but that real work is important in terms of kind of researching the companies in the pre-IPO segment. And I'm sure your 2 decades of experience has given you a lot of network to be able to source these companies. As you mentioned that you have helped a lot of entrepreneurs and worked with a lot of entrepreneurs, and you get deals from them. Bang on. Moving on to you, Abhishek, you mentioned one point which kind of keeps me very confused is that on one side Neil is saying that he's unable to give guidance. His portfolio is having around 50 companies, with top 25 companies adding to almost 85% weight given the current market, right? Your portfolio is comprised of 100 companies with kind of weights as 0.5 to 1.5 per company, like more or less equal weighted 100 companies. Your portfolio is average, you're saying, expected growth is 25%, which is like very good. I'm just trying to give you context because I'm just trying to understand the source of alpha. So on one side, when Neil is maintaining that market is narrow, guidance is tough, times are kind of uncertain, he's maintaining that. On your side, your portfolio is broad, and it is still kind of giving meaningful earning guidance 25%. How is this possible? What is the point that we are missing? If market has so many
Well,
companies which are able to give 25% kind of a average guidance at a portfolio level of 100 portfolios, why would Neil say that market is narrow?
no. I have huge respect for Neil. I think he has raised a very valid point that, of course, there has to be certain concentration. And if you see the Finavenue portfolio, right now we have 80 odd companies, 20 being in the unlisted space, 80 being in the listed space. Even in that 80 companies, if you look at the top 20 holdings, you would see 30%, 35% of the portfolio will be done over there. Now you move to the next set of 60 companies. In the bottom 10 companies, we hardly have, more than less than 6% exposure of the overall portfolio. That means a tad bit of 40 companies will cover the 50% of the portfolio. So maybe the top 20 companies will have a close to 2% allocation. The next 30, 40 companies will have a 1.5% allocation. And the last bit will have, as you said rightly, 0.5% allocation. The reason behind that, Kamal, it's very important that the kind of micro caps and nano caps I put my faith and money in, I also have to live test them for 6 months, 8 months period before I increase the allocation from 0.5% to 1.5%. If you have seen in the market, there are many EPC companies, many manufacturing companies who tell that we'll grow by 30%, we'll grow by 40%. Can you believe them really? I mean, in your mind, you know that, okay, the economy is doing well. You have seen the figures, you know the sector is doing well, but the real time execution, you have to see it for yourself. At very best, today, if a company is saying that, sir, I do a 40% ROC business and I'm at a top line of 200 crores, I want to own that business at 1,000 crores top line, maintaining close to north of 20% ROC, and then maybe I'll give them an equity risk premium of 3.5%. So maybe 22x multiple at top. I have to visualize that 4 years forward journey. To visualize that 4 years forward journey, I have to spend more than 6 to 8 months of real execution time with that same promoter. So you see the big fat in between of 1% odd companies. Many of them will either move to the bracket number 1 of 2.5% to 3%, or they will move to a bracket number 3 of 0.5%. That is why I always maintain this decorum that Finavenue's portfolio is very risk protected at best. You see, I can make a lot of money by doing some concentrated bets, but it will honestly take me 2, 3 mistakes at best and some liquidity adjustment risk or as a icing, and the portfolio will be toast. I cannot take that type of risk in a liquid crunch environment.
No, sure.
You see where the upsides are not that, lucrative at the market. You see the results are coming up, but the stocks are not moving. What will I do by having a concentrated portfolio? Rather, I'll have a diversified portfolio, see in 6 and 7 months how the numbers are faring up, what the market is actually rewarding today. I can top up there, make that alpha, and cut down eventually. So you see, at the end of the day, it's a quant-driven approach. The minute my quant system tells me that, okay, everything is up for a notch, you can put the maximum foot on the pedal, I will do it. I have maintained this stance that since 2024, it's a published newsletter of mine that the bull is for a long nap. And from September 24, we are in Feb 26. You can see the market has not done much except for few sectors. It's a written newsletter from 1st September 2024. So I took a contra view at the top of a bull run. And from that period, I have been only managing the risk meaningfully. So if you see September to 25 cycle, Finavenue delivered what? 17% return at a portfolio level. To again, this financial year, we have delivered what? 10% return on a portfolio level, but my alpha is still above the market. So as long as I am above the market, I am still happy that I'm not destroying anyone's wealth at the moment. And when time will come, the micro caps, they're like cheetahs, as I tell them.
Sure. Abhishek. So basically, right now you are maintaining your focus is on risk management and hence
Absolutely. Working in a micro cap universe, in times of stress, when there is pessimism in the market, you see nothing will work. Only the large caps can rally.
Sure. My only, kind of still a matter of confusion is that while you're maintaining risk, managing risk and kind of having a diversified portfolio, how is it that you are able
Right.
to get so many companies with good, expected growth in earnings in a narrow market? That is something, which is still kind of confusing, if you want to address that for.
There, right. So there are a couple of 4, 5 sectors that we focus upon. All right, BFSI being one of them, manufacturing and infra being another one, electronics being the fourth one, healthcare and urban consumption being the fifth and sixth one. You see, majority of the Finavenue portfolio will be in the proxy or the value chain of these sectors only. I'm not moving outside this. I'm not having any IT companies in my portfolio. Anil very rightly said that as long as you can roll out disruptions from your business, I think in the long run you tend to do well. So I know the growth journey and the profitability of all of my companies 2 years forward. I know what is the end goal valuation they can get, and that is why I am, optimistically sure that yes, on a fair principle basis, this should be their valuation 2 years forward, and hence the CAGR.
Sure. Fair point. Right. Moving on to last set of, I would say, questions, which we want to kind of do from the point of view of understanding way forward, and then, how we are able to kind of keep our emotions aside. Like, from you, Nishad, when it comes to pre-IPO investing, when you meet the promoter, I'm sure promoter gives you his own lot of jargon in terms of plans, in terms of expected growth. How do you keep aside your emotion, biases, the entire compliances thing that you mentioned? I want to understand, the entire process, which kind of is important to understand the risk measures in the current context, and that emotional way of kind of investing that generally happens when the IPO market is hype, and that today that hype has settled. I'm sure there are learnings also. I don't want you to cover learnings, but I know your approach had a massive learning to begin with, because you have been doing this since 2010, and when you launched your fund, you already had a history of having done 100 successful IPOs. So there was a learning curve already. So I wanted to kind of address, how are you able to avoid not getting trapped by the hype, trapped by the emotional jargon given by the promoter? What was there in that process which was able to kind of make you a very scientific decision in entering in a company without bias?
I would say, Kamalji, this is an excellent question. See, human biasness can meaningfully influence the investment decisions. Most of the time, it reflects on a collective cognitive biases, overconfident when the bull market is there, and loss aversion when the corrections happen. So first key is that not to assume that you can eliminate the bias entirely. You cannot eliminate the bias entirely, but to overcome that, you need to have a data proven approach. Now, when you have a data bias approach, the biggest issue is that is the data you're facing is accurate or not accurate. You might take a decision based on data, but what if the data is not right? So for that, what you need to do is have a big influence of the artificial intelligences. Use ratios, consistency of the cash flows, leverage levels, valuation parameters relative to normalized earnings. These are the parameters plus artificial intelligence based. That's why we have invested at a group level heavily into artificial intelligences, where even without meeting the promoters at times, we come to know what is accurate and what is inaccurate. So AI, human biasness will definitely come into the picture, because ultimately we all are human being. But if you give a rejection parameters to the AI, okay, this is not there, please reject. This is not there, please reject. AI will not have the artificial intelligence will not have the human biasness. So first point is that first parameters, learn to say no. Moment the fund manager starts saying no, that's where the growth trajectory happens. So who will say no? Not me. My artificial intelligence will reject the deal if the parameters are not fitting. Second point is that we separate business quality assessment from the valuation assessment. So this basically prevents you from falling in love with a great story at an unreasonable prices. So always have the business quality assessment. And third point, which I personally believe, is that we actively participate in the discomforting analysis. So wherever we have gone wrong, there is no point in saying that no point in saying that I'm always right. So analyze your mistakes, go to the drawing board and come over the strategy, how best you can overcome your shortcomings. So whenever you find any issues or any shortcomings, you must have seen that we go ahead and acquire the companies. We went ahead and acquired Asit C. Mehta, we went ahead and acquired Lead Zen, we went ahead and acquired Analyst.ai. What was that? These were the shortcomings, and we started filling it. So, fund management is like ecosystem. Generate the entire ecosystem. We always see that the one fund manager can make the fund successful. Sorry, here are 4 fund managers. I'm not challenging anybody, but akela fund manager fund nahi chala sakta, sir. Develop the ecosystem. You are in a reasonably safe position. So that's why I said that always have an emphasis on developing the ecosystem, and that's what Bharat Value Fund has always developed the ecosystem. That's where my point is.
Sure, Nishad, absolutely. Totally agree. Moving on to you, Neil, you cannot give guidance on expected growth or expected returns. I agree, compliance stops you, and absolutely, I'm with you. It is absolutely fair point. However, as Warren Buffett says, when it comes to value investing, rule number 1 is never lose money. Rule number two is do not kind of forget rule number 1. I wanted to give guidance on the quality of the portfolio that you have, because when you did assessment of entering in each company, I would say point by company, I'm sure your own money is also invested in the fund. In terms of risk cognizance, in terms of quality, how would you want to kind of see your entire portfolio and comment on your entire portfolio and give guidance on your portfolio?
I think all the panelists have touched upon some good points. So I kind of, this answer would borrow a little bit from everyone. So first is where the world is headed, and you want to be in the slipstream of where the world is headed. So you have less friction. You don't want to own companies going through difficult cycles and uncertain futures. So we've kind of started to look at companies in an AI integrated world going forward. So firstly, we want to be part of the build out program for the infrastructure around artificial intelligence. So we have IP led businesses under the manufacturer. So we want to be hardware plus software as a key theme. Um, so IP, moats, defensibility, all of these things in these kind of sectors, which will be I think where the earnings will be protected for the next few years. So one is this AI build out as a theme. So energy security, energy solutions, these kind of names have a higher weightage. As I said, defense. Again, in defense, we don't want to do commodity stuff. Somebody is making a vest for army. We don't want to do that. We want to be in, again, companies which are niche, who are doing things that other people cannot simply come and do, or who are pick and shovels, in a gold rush, those kind of names. I spoke about healthcare, where we think a hospital chain could be a decent way to go about it. I also feel there's a lot of currency debasement that is going to happen going forward because of the way the macroeconomics is shaping up around debt globally. So in a situation of currency debasement, what are the kind of assets I need to own going forward? Is a question I ask myself. So I think the very definition of a textbook investment is changing as we speak. The narrative in the next 6 months is going to be much different from what it is today. The narrative is going to shift towards protection of earnings and lesser about return on capital, things like that. So I think let's not talk about guidance. I think it's very clear about where the world is headed, and I think if an investor can understand what is likely to happen, then there are 6-7 good themes right now. And what we are doing is focusing around those 6-7 good themes. And large part of our money, as you said, you've seen that the top of our portfolio is kind of going in a direction right now. So we're almost done with our rebalancing. I think this call has been taken at our end, and we've started to say no to everything right now. I don't think I've done any transaction in the last many days, last many months. we've been looking at just changing the direction of the portfolio towards where I think earnings growth is likely to be protected. So that's where I'm at. I think if you do this successfully, market's not cheap right now. You cannot table thump and say buy everything. But right now the time to rebalance and look at where the next 5 years, where either you're building out the AI theme or you are in sectors which are completely anti-fragile and own good number of stocks in these few directions, I mean, in these few sectors, and be narrow in your approach and take a call in life and go with what you think is going to happen in the next 4 or 5 years. So we've done that. I'm fairly secure in my mind as to how we are positioned right now.
Sure, sure. No, this is very, I think, real and honest answer, Neil, and I really admire you for that always. Moving on to you, Vineet, in terms of understanding the risk containment, I would say, ideology at your end. When you mention that you get referred to a lot of deals by way of your old, I would say, network that you have created, and many entrepreneurs, one entrepreneur makes you meet with other entrepreneur. At times, it becomes difficult also to say no. How would you kind of keep your bias away? Because some reference by someone is like something that where you have to kind of objectively evaluate it, and you have to say no also, because investing is all about selecting one amongst 100. And when you are kind of doing your assessment at your level, I want you to kind of give us a context. How many deals would you have denied? How many, when you do activity on the ground, you mentioned that your primary research and a lot of real work that you're doing. I want you to kind of give a very realistic answer that, if you have selected a company, you selected it after these many, I would say, numbers of no's, and were you able to really say no? And were you able to kind of, is there any 1, 2 example where you actually wanted to say no, you could not say no, and now you feel that, I think it is a lesson that you have learned. And early lessons, everybody has learned. Like Neil also learned early lessons, in 2017, 18, 19. And I know of that. I have traveled with him that journey. So early lessons maybe you would have also learned. So I wanted to come up with a very real answer, because that gives a very good context to the investor who is giving his hard-earned money, to a fund manager.
So, as I said, we get a lot of deals. A rejection ratio would be about 9 out of 10 that we receive. So yes, we do say no to most of the transactions that come through. We have a 5-pointer framework which is used as a filtering tool. I don't even talk to the founders for the first time. It's the team who runs the process. Only once it meets the criteria is then it comes for discussion. So rejection happens a lot. Even after doing that, mistakes will happen. Now, if you ask me, something we should have said no, but we didn't say no, I won't say that. But something we said yes, we liked the business, we liked everything, but probably the intent of the promoter was not right, which you can never know. If somebody is there with a malice and a negative intent, that he'll come to know only through the journey. Uh, and of course, a lot of people do show the transactions. We've also seen what they show and what, how their investments have fared, whether we said no or yes. So there's a track record, because if we said no, somebody did invest, and you track how those companies are doing. So yeah, we reject a lot of transactions actually before we get into one. And as I said, we spend a lot of time on the ground after that. In fact, there's an anecdote from last month. I was visiting a plant in Pune, near Pune, a small town. And there are about 5 or 6 funds who've invested in that company at the pre-IPO stage. And we're not the largest investors in that, but we're the second largest on the cap table. Uh, the largest investor was actually a fund from Pune itself. He said, "Sir, you're the only fund manager who's come fourth time. None of the fund managers even visited the plant once after putting the money." Now, that tells you the difference. We actually spend a lot of time, either I would go or somebody from our team would go on a continuous basis to see. Because when you visit it again after 6 months or 5 months, you see the progress, you see what's happening and what the guy told would be happening by this time, has it happened or not. Uh, So, that's what actually differentiates you or will differentiate you in the long run. Of course, we do take concentrated bets because that's when you deliver a significant alpha. In fact, India Fund, we started in July and we are up about 60-70% in this market, despite a large part being unlisted. Singapore Fund, which we've been running for almost 4 years now, it has a dollar CAGR of 43%, which means, including the currency impact, and we outperform the markets by a huge, huge margin, despite some mistakes that we've made. And, that will happen as part of the journey. We're all humans. My thumb rule is if you do 10 investments, two, three, you will lose money on the table and get up. Three, four, you'll make average or slightly above average returns. And then you'll have two, three multi-baggers, which will generate the significant alpha for you. Uh, if you could get all right, we'll be gods. We are all humans and we will make mistakes. And somebody's always smarter than you. So, you're not the smartest person, irrespective of what we think of ourselves. So there's somebody smarter than you who'll take you for a ride. And that's part of the journey, part of the learning, part of the lessons you take, you accumulate those wisdoms and go on.
No, bang on, Vineet, absolutely. We are kind of moderating this entire conversation for our clients, for our audience, to kind of tell them that value investing is not like low P investing. It has a lot of process, lot of insight, and mistakes do happen. But then there is a corrective action which is taken by fund managers based on their, I would say, signals and their experience and their good intent. And all value investing actually begins with finding out good promoters with good intent, and it is an ongoing process, and alpha generation through value investing is not easy, and hence these discussions kind of are very important to understand where we are in the process of kind of that alpha generation in the long term journey to all our clients. My last question for last 1 minute, we are already running out of time, from you, Abhishek, is that your portfolio is comprised of 700 crores of assets in 100 companies. Have you said no to kind of any company when it came across the table? I'm sure many times, like, we discussed that, investing is all about selecting, very finely selecting. But your portfolio AUM versus number of stocks make me ask this question: what is your process of saying no?
Kamal, I'll give you a straight number. Since 2023 till now, we have seen more than 745 companies, more than 745. Finavenue has selected only 85 of them. Out of 85, only 20 or 24 is where I have held them since the beginning. I held them for more than 1.5 years. That means they have been able to deliver quality earnings over time. There is one thing where you can definitely show growth in the earnings, but then there is no growth in your operating cash flow. I mean, that type of earning is not appreciated well in the market. Okay, so out of 85, only 22 to 24 have been able to deliver that thing. Rest everywhere also we made money, but I would say with time the quality of earnings deteriorated and hence we exited as well. So on a level 1 filter, we have done only 10% of market. On a level 2, even within our portfolio, we have trusted only in 35% of our own company for a larger, earning cycle. So that is a 2-pointer, stats for you to tell you that we are very rigid when it comes to filtration and quality checks. If you show me the DHRP of a last 3-year performance, I will not sit there. Okay, my team will go to the ROC and will pull out all the financial data from back DRHP as well, the ones that is not in front of you or for the retail investor to look at. You tell me that your EBITDA margin is around 15-16%. I cannot believe it on the face value. I will look at all the listed and unlisted companies in your size. It's very important in your size and look at what is the figure going on in the world. Promoter intent, as every panelist member over here have talked about, is of prime importance to us, and field visits. I mean, the kind of companies that we are looking at, in a year, if I visit less than 3 times, then I don't think so I'm serious about it. I have to be visiting there more than thrice. And, this is the space, this is the filter which needs constant rechecking from the fund managers and the investors' perspective. It's very important. We can go wrong at any moment of a time. So risk allocation, right diversification, and, constant tracking is the cardinal principles that we should live by, at least in the space that we are putting money in.
Sure. Thank you, everyone. And I would just like to add one more point to the conclusion, that to all our clients and investors who generally feel that why some of these value investing funds come at a performance fee. Fees is another aspect we discussed. You can kind of assess yourself. So much hard work goes behind, and continuous work goes behind, assessing and reassessing the company after investing. And hence, the performance that you get, comes at a cost of a performance fees. And thank you, everyone, for this panel discussion. It was very insightful. Over to you, Aishwarya.
Thank you.
Thank you very much, Mr.
Thank
Manocha,
you.
for starting us off on such a wonderful conversation. And thank you to the eminent panelists as well. Now, that conversation reminds us that real value is discovered through patience, discipline, and deep research, not headlines. So we're now going to take a short 2-minute transition as we prepare for our next session. Now, during this time, I invite you to visit the dedicated areas apart from auditorium, like the breakout rooms, networking lounge, a lobby with an information desk, and so on. While we quickly line up the speakers for the next session, please explore all these options for a better experience. It is a digitally immersive experience for you, so make the most of it. I'll see you in 2 to 3 minutes only.